If you are new to the channel, make sure to hit the like button and subscribe, because today we are diving into a detailed analysis of NIO, one of the most talked about electric vehicle companies in China. By the end of this video, you will know the company's fundamentals, financials, competitive positioning, risks, and where the stock could go next. NIO is one of China's leading electric vehicle manufacturers and has positioned itself as a premium EV brand. Unlike traditional automakers that sell combustion engine vehicles, NIO focuses exclusively on smart electric vehicles with advanced autonomous driving technology and a unique battery swap system that differentiates it from rivals like Tesla, BYD, and XPeng. The company currently offers models such as the ES6, EC6, ES7, and the ET series sedans, and it has been aggressively expanding both its product lineup and its international footprint. From a financial standpoint, NIO has had a challenging past few years. Deliveries slowed in 2023 and 2024 as competition in China's EV market intensified and as consumer demand weakened due to a slower Chinese economy. The company's revenues for full year 2024 were roughly around $7 billion, showing modest growth compared to the previous year, but profitability remains elusive. NIO continues to report net losses as it spends heavily on research, development, and infrastructure, particularly its battery swap network. However, gross margins have started to recover in recent quarters after hitting a low in 2023. Vehicle margin has improved due to cost reductions in battery packs and stronger sales of newer models. Looking at the balance sheet, NIO has strengthened its liquidity position through a mix of equity raises and partnerships with state-backed investment funds. While debt levels have grown, the company maintains enough cash reserves to sustain operations and fund future expansion. This financial flexibility is critical as the company pushes deeper into Europe and potentially North America over the next several years. From a fundamental perspective, NIO trades at a valuation that reflects both investor skepticism and potential upside. The market capitalization sits well below its all-time highs reached in 2021, which means investors today are pricing in slower growth and continued losses. However, if NIO can demonstrate consistent delivery growth, margin improvement, and progress toward break-even profitability, the stock has significant room to re-rate higher. On the competitive side, NIO faces immense pressure in China. Tesla continues to dominate the premium EV segment with its locally produced Model Y and Model 3, while BYD has been capturing mass market share with lower-priced vehicles. XPeng and Li Auto are also competing aggressively. What sets NIO apart is its focus on premium branding, user experience, and the innovative battery swap model, which allows drivers to replace a depleted battery in minutes instead of waiting for a charge. If this system scales effectively, it could be a long-term advantage that builds customer loyalty. When we analyze risks, the biggest factor is the highly competitive Chinese EV market. Price wars have already forced companies to cut margins to maintain sales volumes. There is also regulatory risk tied to both the Chinese government's EV policies and potential trade restrictions with Western countries. In addition, NIO's path to profitability remains uncertain, and any setbacks in scaling production or expanding internationally could weigh heavily on the stock. On the opportunity side, the global transition toward electrification continues to accelerate. China remains the largest EV market in the world, and NIO has established itself as a recognizable brand. The company's focus on software, autonomous driving, and premium user services could allow it to carve out a defensible niche. If NIO can reach annual deliveries of 500,000 vehicles by the late 2020s, with vehicle margins above 20%, the company could turn profitable and justify a much higher market valuation. From a technical analysis perspective, NIO shares have been volatile. The stock is trading far below its highs of over $60 during the EV boom of 2021, now hovering in the low to mid-teens. There appears to be strong support in the $10 range, while resistance levels sit closer to the $20 mark. A breakout above that level with strong delivery numbers could signal a new bullish trend. So what is the bottom line? NIO remains a speculative growth investment. The company has real innovation, a strong brand in China, and long-term potential if it executes properly. But profitability remains years away, competition is fierce, and investors should expect volatility. For risk-tolerant investors who believe in the growth of the Chinese EV market and NIO's ability to differentiate through battery swapping and premium branding, the current stock price could represent a long-term buying opportunity. My recommendation is a cautious buy for investors with a multi-year horizon. NIO is not a stock for short-term traders looking for quick profits, but it could reward patient investors if the company continues to scale, improve margins, and expand globally. Thank you for watching this NIO stock analysis. If you found it helpful, make sure to like the video and subscribe for more deep dive investment breakdowns every week.